So example on the purchase method when there is a positive goodwill. On December 31, 2018, Mason Company was merged into Saxon. This means that Saxon is the combiner and Mason is the combinee. Saxon wants to combine with or acquire Mason. Saxon issued 150,000 shares of its 10 par common stock. The current fair value is $25 per share. To Mason's stockholders for all Mason's common stocks. In addition, Saxon paid the following out-of-pocket costs. Here are the out-of-pocket costs. We have accounting fees, we have legal fees, we have finder fees. Of course, we already know by now that only for investigation of Mason and for the business combination and finder fees, the three figures are the only direct out-of-pocket costs. We also have the balance sheet for Mason Company in book value and fair value. You are required to prepare the journal entries needed to record the business combination between Saxon and Mason. So we are going to follow the same steps like example 1. First, we need to calculate the purchase price or the investment, which is equal to the market value of stocks plus the direct out-of-pocket costs. The market value of stocks equals to 150,000 shares multiplied by 25 plus 14,000 plus 10 plus 51. These are the direct out-of-pocket costs. This will be equal to $3,825,000. Okay. Step 2 is to calculate the fair value of combinee's net assets. How? We subtract the fair value of assets from the balance sheet minus the fair value of liabilities. Here we add all the assets in fair value minus all the liabilities in fair value. The difference will be equal to 3,700,000. Here we can notice that there is a difference. These two figures are not equal like the first example. Here the amount of investment equal to 3,825,000, okay, and the fair value of the net assets of the company equal to 3,700,000. This means that Saxon is willing to pay more than the value of Mason in order to complete the combination. This means that Saxon is keen to do the combination with Mason, even if it's gonna pay much more than the value of Mason. So how we get the goodwill or the positive goodwill? We subtract the purchase price minus the fair value of assets equal to 125,000. This is the positive goodwill and this is an asset. It will appear in the balance sheet. Step 3 is to prepare the journal entries. We start by investment in Mason in the debit side, which is equal to 150,000 share multiplied by 25 equals 3,750,000, and calculating the common stock in the credit side, 150,000 multiplied by 10, which is the par value, which equal to 1,500,000. The difference between the value of shares in market price and the value of share in par equals to 2,250,000. This is called paid in capital in excess of par. This entry is to record the merging with Mason. Another journal entry to record the costs. We have direct out-of-pocket cost, which is 14,000 plus 10 plus 51. This will be charged into the investment in Mason account, which equal to 75,000. And we have another out-of-pocket cost considered as expenses. We call it paid in excess of capital. 60,000 plus 51, 250 plus 23,000 plus 750 equal to 135,000. Both will be paid in cash, so cash will appear in the credit. Then we get all the assets of Mason in fair value and place it in the debit side, And don't forget the goodwill. We have goodwill for 125,000. It's an asset for Saxon now. And the liabilities of Mason in the credit side here, and place investment in Mason in the credit side to close it. 3,825,000 investment in Mason equals to this figure plus 75,000. Okay, and don't forget the discount on long-term debt, which is equal to 50, because the fair value of the long-term debt is less than the book value.